Equity Market Update, February 2023. Indian equities declined third month in a row with Nifty 50 and S&P BSE Sensex declining by 2% and 1% respectively in February 2023. The key factors driving the market includes concerns around longer than expected hawkish policy stance by central banks, resurgent geopolitical tensions, announcement of budget, rate hikes by central banks, and volatile move in stock prices of a large domestic group. Large caps performed in line with mid caps but outperformed small caps. The month saw broad-based decline across most major sectors. Power, metals, oil and gas, auto and healthcare underperformed, while capital goods and FMCG ended marginally positive compared to last month. The performance of major global equity indices was mixed, with Hang Seng and US markets underperforming, while European market outperforming. FPI sold equities worth $0.6 billion and have cumulatively sold equities worth $6.1 billion in FYTD23. On the other hand, DIIs bought net equity worth $2.3 billion in February 2023 and have cumulatively bought approximately $28.5 billion in 11 months FY23. Net inflows to mutual funds in January 2023 inched up to INR 21,000 crore approximately and INR 188,000 crore in 10 months FY23 approximately. Of the Q3 FY23 results, earnings of banks, NBFCs, auto, industrials and IT were better than expected, while that of consumer staples, cement, oil and gas and telecom were largely in line with expectations. Results of consumer durables, metals and pharmaceuticals were lower than expectations. Outlook: as on 28 February 2023, Nifty 50 was trading at approximately 18.8x FY24E and 16.1x FY25E price to earnings ratio. While the valuation multiples have moderated from recent peak, but can be considered elevated vis-a-vis its historical average. However, one should view the same in the context of structurally attractive nominal GDP growth, robust economic recovery, and healthy corporate earnings outlook. The ratio of India's market cap to GDP based on CY23 GDP stood at approximately 85% of its recent peak. The gap between 10-year GSEC and 1-year forward Nifty 50 earning yield has also narrowed, but still higher than its long-term average. Thus, overall, the market appears to be reasonably valued. The valuations for major sectors are close to or higher than long-term averages. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in the near term. Outlook for the market is likely to be driven by expected growth in nominal GDP and corporate earnings growth, relatively optimistic domestic growth outlook, steady corporate profitability, growth supportive policies, improving rural demand, etc. bode well for the economy and equity markets over the medium to long term. Longer than expected monetary policy tightening by global central banks, especially US, sharp increase in US yields, sustained elevated inflation, continued FPI's outflows, escalation of geopolitical issues, etc. are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.